So then I think just on the, we've spoken deemed supplies and so forth. The input, and then it's just the special rules. What I would also suggest, guys, as well, is, as you can see, that there's quite a lot when it comes to VAT. So it's important that you also take the time, have a look at what is contained, for example, in the slides. So use a combination, so not conjunction, a combination of the slides, and the legislation textbook, to come up to speed with everything that is VAT related. Okay, so the one thing I then like to talk to, it's just that, and then we'll then have a look at the tutorial and have a more discussion on the tutorial. I am sharing my screen, eh? Yeah, I think I am sharing my screen.
Yes, you're sharing your screen, yes.
Okay, cool. Thank you for the confirmation. So it's just on the, now on the, so CGT. Now again, I like, because we've got limited time, we're not talking comprehensive. If you're doing a CGT lecture, you'd have to do that lecture over a number of days. But so we'll try and again and put that talk about this within a short space of time. As I said earlier on, there are things that are available. And when I say things that are available, I mean, when I say things that are available, I mean, sorry. So when I say things that are available, I mean the videos that have got more detail in them that you can then use to extend on the discussion that we have. Okay. Right. So then let's have a look at apologies, bit of a distraction there. Okay, let's have a look at capital gains tax. So now, what is capital gains tax? So capital gains tax is dealt with in the 8th schedule. Okay, where any transaction, remember earlier on we spoke about transactions that are revenue in nature and transactions that are capital in nature. Okay, so there we're looking at and saying, okay, fine, if a transaction is capital in nature, it will then be subject to capital gains tax. And of course, capital gains tax is at a lower rate than anything that is revenue in nature. Okay, now what are these things? So how do we manage capital gains tax, and how do we ensure that we correctly account for it, and how does it integrate within the 8th schedule? Right. So first things first, what I want to do is, so maybe let's first start off here on a high level view of how do we then calculate capital gains tax. Right. So you'd look at one, when you're determining your capital gain, you'd look at all the sum of your capital gains. And remember, guys, that when you are calculating capital gains, you need to calculate capital gains on an individual asset basis. Okay, so you calculate capital gains tax on an individual asset basis. So that's why when you're looking here and you're saying it's the sum of capital gains, it's because you have taken the individual assets and calculated each asset's capital gain, and then you are then summing up all of those capital gains. Okay, similarly to capital losses, you've calculated the individual capital losses and summing all of those up. And then if you are a natural person, you will then qualify for an annual exclusion. Okay, so if you are a natural person, you will qualify for an annual exclusion. Okay, and that annual exclusion, of course, will be an amount of 40,000 rands in each year of assessment. And in a year of assessment where a person dies, it increases to 300,000. Okay, so you then have an annual exclusion of 300,000. if you've got any assessed capital losses that you are carrying forward from a previous year of assessment, then that assessed capital loss is then included as part of the taxable capital gain. Okay. And then once that is done, then you then look at, you then have your net capital gain and you apply the inclusion rate. And of course, the inclusion rate depends again on the nature of the taxpayer. So for natural persons, 40%, whereas for companies, it's an inclusion rate of 80%. Okay. And then that amount in terms of Section 26 Cap A is then included as part of the taxable income of the taxpayer. Okay. And I think the important thing then is when you're looking at the slide is to then say, okay, fine, it says that in order for you to levy capital gains tax, there must be the four things that are present, which is a disposal, assets, proceeds, and base cost. So now sometimes you'll ask yourself, but why specifically these four things? What is it that informs us in order for us to then say we must have these four things? Okay, so let's open your legislation and open your legislation on the fourth schedule, on the 8th schedule. So if you open your legislation on the 8th schedule and you go to paragraph, so in the 8th schedule, if you go to paragraph, I'll be there now. So if you go to paragraph 3, so 8th schedule, and you're looking at paragraph 3 of the 8th schedule. Okay, give it a couple of seconds so that everybody can page through to the 8th schedule, paragraph 3 of the 8th schedule. So paragraph 3 of the 8th schedule. Okay, so hoping everybody is now there. Okay. So if everybody's there, so let's read what it says. So paragraph 3 of the 8th schedule tells us how we calculate a capital gain. So there it says a person's capital gain for a year of assessment in respect of the disposal of an asset during that year is equal to the amount by which the proceeds received or accrued in respect of that disposal exceed the base cost of that asset. Okay. Now let's try and decipher what I've just read. So it starts off and says, so a person's capital gain for a year of assessment. So again, similar point that I made when we were looking at gross income, in that tax is a yearly event or an annual event, and therefore you must account for that transaction in the year that it takes place. Okay. And then it then says in respect of the disposal. So one, a disposal must take place. And what it's a disposal of what? It's a disposal of an asset. So two, there must be an asset. And then it then says during that year, that capital gain is equal to the amount by which proceeds. So three, you need to have proceeds. And the last thing you need to have then is number 4, which is then the base cost. Okay, so that's how, whenever you are taught CGT, your lecturer will say to you, in order for you to have capital gains tax implications, the 4 pillars of CGT need to be present. And the reason why they say the 4 pillars of CGT need to be present, it's because when you're looking at capital gain, and it's a similar thing when you're looking at paragraph 4 of the 8th schedule, which deals with a capital loss, it requires the same things. There must be a disposal, there must be a disposal of an asset, there must be proceeds, and there must be a base cost. So those 4 things need to be present. Okay, so those 4 things need to be present in order to have capital gains tax. Okay, so then again, capital gains tax is then centered around these 4 things. That's why when you're looking at the legislation, you'll see that it's centered around these 4 things, and these 4 things are what ultimately drives the majority of what's contained in the 8th schedule. Okay, so let's start off with an asset. So then what would constitute an asset? When you're looking at that definition, again, a very wide definition. It's a very wide definition that then says, okay, an asset is property of whatever nature. So as you can see, anything under the sun can be an asset. Again, when you're talking property, remember when we're looking at gross income, property constitutes anything with a monetary value. So anything with a monetary value, whether it's movable or immovable, corporeal or incorporeal. So corporeal means tangible, incorporeal means intangible, whether it's tangible or intangible. But it must exclude any currency, but including any coin made mainly from gold or platinum. Okay, so it does include any coin that is made mainly from gold or platinum. Or it could be a right or interest of whatever nature to such property. Okay, so it's property of whatever nature. And yeah, it includes any coin made mainly from gold or platinum. So again, there we're looking at what is an asset. Now, when it comes to non-residents, remember, for residents, they get taxed on their worldwide assets, whereas non-residents will only get taxed on assets situated within the Republic. Okay, so non-residents, only assets that are situated within the Republic. And what would those assets be? So then if you are a non-resident, you'll still be subject to capital gains tax on any movable property that is situated within the Republic. Okay, or any interest in that immovable property. So if you own a percentage of immovable property, that's an interest in that immovable property, and therefore you'll still be subject to tax on that interest. Okay, or where you've got assets that are attributable to a permanent establishment. So when you've got assets attributable to a permanent establishment, and that permanent establishment is situated within the Republic. Okay, assets are situated within the Republic, and it's a permanent establishment that is situated within the Republic, even though that permanent establishment might be a permanent establishment that belongs to a non-resident. But as long as those assets of that permanent establishment are situated within the Republic. Okay, then the last one is if you own shares in a company that will refer to as a land-rich company. So you own shares in a land-rich company. So you own shares in a land-rich company, the disposal of those shares will be subject to capital gains tax in South Africa. Okay, so 3 instances when non-residents get taxed. It's on immovable property, on assets attributable to a permanent establishment situated within the Republic. And the last one is if you own shares in what we refer to as a land-rich company. So those are the 3 instances where non-residents will be taxed on, will be subject to capital gains tax. And remember, a land-rich company would be a company where 80% of its value is attributable to immovable property that is situated within the Republic. So hence I refer to it as a land-rich company because 80% of its fair value is attributable to immovable property situated within the Republic. And of course, those shares that you must own in that company must be at least 20%. So you must own at least 20% of the shares in that company.
So can I ask on point number 3, what is bringing rise to an immovable property? Is it a company that has immovable property or what?
Say that again.
It says that equity interest in an entity where the non-resident the equity interest is attributable to immovable property. What do they mean? Which immovable property within the company? How is it related to the equity interest?
Okay. So what we're saying, remember there's a company. So let's say there's a company that owns immovable property within the Republic. Okay. And 80% of that company's fair value is as a result of the immovable property that it owns in the Republic. Still follow there?
Yes, I do. I actually understand the whole part because I just wanted to know where's the immovable properties coming from. But then now I understand that it is the company that is owning the immovable property.
Yes, so it's the company that owns the immovable property. And because the company owns the immovable property, we then say, when we're calculating the fair value of that company, is 80% of its value, fair value of that company, attributable to that immovable property? If the answer to that is yes, then we then say, okay, fine. As the non-resident, do you own at least 20% interest in that SA company? And the answer to that would be yes. Then we'll then say, okay, fine. When you dispose of those equity shares in that SA company, those equity shares will then be subject to capital gains tax.
Okay, it makes sense. And with regard to money market in terms of the definition of an asset, how is it different? How do you know that money market is actually an asset in terms of CGT?
But a money market account is cash, so it can't be an asset because cash is specifically excluded from the 8th schedule.
Okay, because I actually done a question whereby it was money market and then it was calculated capital gains on it.
No, my understanding of a money market account is it's like a fixed deposit. It's just that you would then receive favorable rates on that money market account.
Okay, maybe it might be that I did not really understand the question, but it was like that. I don't know.
Okay. Look, if you do come across the question, maybe just drop it on WhatsApp.
Okay, definitely.
Okay. Okay. So the other thing to consider, of course, is that if a resident ceases being a resident, so I decide that I am moving to another country, and I then write a very nice letter to the tax authorities, and I say to them, guys, I am moving to another country. I do not intend coming back to South Africa, and therefore I would like to be classified as non-resident because I do not intend coming back to South Africa. And therefore I do not want to pay taxes in South Africa. Then the legislation says, fine, you are well within your rights to do that. And once that has been done, what will then happen is that you will be deemed to have disposed of all of your assets. Okay, so you are deemed to have disposed of all of your assets, and you are deemed to dispose of all your assets on the day before you cease being a resident. Okay, so all of your assets are disposed of on the day before you cease being a resident. And then you are then subject to capital gains tax. Of course, having said that, you still will be subject to capital gains tax to the 3 exceptions that we're looking at on the slide. Okay, because those assets will still be subject to capital gains tax in South Africa. So then you are not deemed to have disposed of them at that point in time. Okay, whereas any other asset, you are deemed to have disposed of it at its market value. Okay. Right, let's then look at disposals. So when you look at disposals, we're talking section 11 paragraph 11 of the 8th schedule, which then says, if you look at the general definition under paragraph 11, it says that a disposal means an event, act, forbearance, or operation of law. Okay, so a disposal is one of those 4 things: any event, act, forbearance, operation of law. And then one of those 4 things must result in something. So you can't just say, oh, there's an event that took place. That event must result in something, or that act must result in something. Okay, what are the things that they must result in? Okay, they must result in either a creation, variation, extinction of an asset. Okay, so it results in the creation, variation, or extinction of an asset. Okay, so one of those 4 must result in creation, variation, or extinction of an asset. Then we'll then say that is a disposal. However, if you then look at paragraph 11, subparagraph 1, it then has very specific transactions that are included as disposal events. Okay, so because they are specifically included as disposal events, then you do not need, what can I call it? You do not need to use the general definition in the determination of whether you've got a disposal or not, because you've got items that are then specifically included as disposal events. So for example, if a sale has taken place, that is a specific disposal event, and therefore you have a disposal. There's no need for you to go through the definition of an event, act, forbearance, operation of law. It's simply saying there's a sale. So then you'll then say, in terms of paragraph 11.1a, a sale transaction is specifically included in the disposal definition, and therefore a sale has taken place, or therefore a disposal has taken place. Okay, that's now you responding to a question. Or in an instance where there is a donation that has been made, so a donation is specifically included as a disposal event. In an instance where you forfeit an asset, then that's a disposal event. In an instance where there is a cancellation, let's say there's a cancellation of debt, that's specifically a disposal event, or where you are discharged from debt without you having paid for that debt that you're discharged from, that would be a disposal event. Okay, where there's a release or a waiver, or there's an abandonment of an asset, that's a disposal event. Okay, so if you decide, let's say somebody owes you money, and remember, when somebody owes you money, you have an asset, and you decide to abandon your right to that money, that means you have disposed of your asset. And your asset, remember, is the right to receive that money. So if you decide to abandon your right to receive an amount, you have made a disposal, and therefore you'll then be subject to capital gains tax on that amount. Okay, any scrapping or any loss or destruction of an asset, or maybe the granting, renewal, or extension, or exercise of an option. So the list is quite not necessarily exhaustive of everything, but if you look at paragraph 11.1a, you've got a listing of certain events that will then qualify as disposal events. Over and above what is specifically included as a disposal event, you also have events that are specifically excluded. Okay, which is then paragraph 11.1.2, if I remember correctly. Yeah, 11 paragraph, sorry, not 11.1.2, man, sorry, I'm talking nonsense. It's paragraph 11, subparagraph 2 of the 8th schedule, which then say the following transactions are excluded specifically from being classified as disposal events. So if there's any transfer of an asset as security for debt, that would not be a disposal event. What does that mean? Let's say I want to get a loan from the bank, and the bank says to me, give us your car as security. I then say, okay, fine, I'll give you my car as security. It does not mean I've disposed of my car. All I've said is that in the event that I fail to pay for this loan, you can take my car and sell it. So when I give my car as security to secure that loan, I have not made a disposal. But in an instance where I fail to pay the loan and the bank actually takes my car and sells it, then in that instance, yes, I have disposed of an asset, which is my car. Okay, so then if you then look at paragraph 12, which then deals with deemed disposals, remember there's certain transactions that are not disposals as we're looking at paragraph 11. However, some of transactions will be deemed to be disposals. So for example, if you commence to be a resident, you are deemed to have disposed of all of your assets before becoming a resident, and you have reacquired those assets once you become a resident. Now, the thing about that is that it's not necessarily that you will be subject to capital gains tax in South Africa when you become a resident. What it means is that when you become a resident, we are merely trying to establish what is the base cost. So it's establishing the base cost of your assets that you owned before becoming a resident of the Republic. Yes, so it's merely establishing the base cost of the assets that you owned before you became a resident of the Republic. Okay, you guys. Please excuse me, guys, for a minute. Sorry, I've got an unwanted visitor. So let me just take care of that and then we'll continue.